Good morning, friends, and welcome back to the Trade Speakeasy. Most of you are probably finding us at tradespeakeasy.learnworlds.com. If not, then you can find all of our courses, webinars, and upcoming conversations there. So today I wanted to revisit a topic we talked about last week, which is the discussion regarding the EMAs, crossing positive or negative. And specifically, we were looking at the death cross and the golden cross, where the 20 EMA is above the 200 EMA or the 20 EMA is below the 200. And so one of the things that we really have to look at in regards to that are the different sectors to see what is happening in the overall markets, both if we have enough support and participation from the different sectors in order to go back into our bullish trend, or if we are still with weaker breadth and weaker participation, and we may be carrying on in this more bullish move. And oftentimes you will hear people, bearish move, I should say, but oftentimes you will hear people talk about a secular bearish market, which is more of like a long-term overall bearish market, or a bearish cyclical market, which is really after you've had a really aggressive bull run that you have this kind of cyclical movement in the market that requires it to kind of to breathe back to some of its EMAs and to allow price to catch up in a more natural way. And since in 2020, we really saw a strong bullish move, and then we continued with that bullish rally through 2021, but with a bit more hesitation or hiccups, less kind of, just with straight conviction and movement in one bullish, like slow melt up. We did see a lot of weakness in participation as the prices of the SPX and NDX continued to rally into the end of 2021. And really at the end, quarter Q4, we started to already see some weakness. But now, of course, we have essentially hit that 10% correction from the all-time highs to the current relative lows that we visited last week on the SPX, when we came down to that like 430 area on SPY. Now let's just go and look at the different sectors. So XLY, which tends to be an area of strong growth, is usually one of those more risky areas, consumer discretionary, where we see a lot of those strong moving stocks like an Amazon. We've obviously not been seeing that. And in the beginning of the week, when we were starting to print, a few of those stronger bullish candles, we thought we might be pulling back into a positive trajectory. But yesterday and the day before, Wednesday and Thursdays, negative momentum, even with Amazon's kind of bullish aftermarket move, we're still seeing that 20 moving average is now approaching that 200 moving average. So next week, if we don't have a lot of significant bullishness in the consumer discretionary area, we will see that death cross appear. So this is really not just neutral movement. This is really selling movement if you are holding shares in any of these underlyings, because essentially the sector is not moving in a positive direction. Unless you are shorting these stocks, then you might find some support from the overall negative movement in this sector. Now, XLK had also been lagging behind in the sectors, and now we can see, we are seeing a bit of positive change. As you can see here, the 20, this yellow line, has come down, and now it's starting to move back up. If we can get the 20 above the 50, then we will be in a completely positive trajectory. But really, considering the negative movement that we've had in some of those other, the other tech stocks, not Apple and Microsoft have been okay, but just the wider tech sector has been really heavy. And of course, Thursday, we did see a significant drop. So we really need to be paying attention to see if price is going to head back down towards that 200 moving average. And if it does, then we are likely to see in the next week or 2 weeks, potentially a death cross as well on the XLK, which is the other risk on growth sector. Now, if we go to industrials, which a lot of people expected to see some positive movement in this kind of winter to spring season, we are seeing some. It is a neutral essentially at this point. The 50 and the 20 continue to be close together, but because of the fact that we had a lot of consolidation from really around June of 2021 all the way now till February, we're just seeing that XLI is moving in this corridor. And so actually all three of the moving averages are moving really closely together. And so it's not impossible that if we continue to have flat to bearish days, that we might actually see a death cross appear on XLI. And again, that is an area where we were expecting a bit of bullishness because of the potential government investment into infrastructure, but that has continued to be this sector has continued to be a laggard. Now, if we go to energy, we see a strong positive stacking. The 20 is pulling away from the 50, which is pulling away from the 200. And it continues to be a strong sector. And this continues to really help the SPX or the S&P opposed to the NASDAQ, because in the weighting, in the composite of the S&P, the four heavier weighted sectors are XLK, XLY, XLE, and XLF. So let's check out XLF and see how that is performing. Now, at the moment, we're kind of dancing with a potential dark cross, which would be if the 20 comes below the 50. And considering that there were a lot of heavy reactions to the financial sector's earnings reports in the previous week, it is not strange to find that the 20 and 50 continue to just slowly melt up, but it is a more positive sector than what we are seeing with XLK and XLY, where we've already turned towards a negative stacking, or we're moving towards a complete negative stacking, since that 20 is already below the 50. But here the 50 and the 20 are just dancing with each other. But that is heavy, and that continues to be heavy for SPY or for SPY or for SPX to make that move back up to all-time highs. Now we will look at the more defensive sectors. This is really risk off. This is where we might be seeing institutional money rotating into. We actually have been seeing money rotate into institutional money, rotate into that sector, as well as XLE and XLF. But we will now let's look at materials, XLB. And okay, this is giving us a neutral sign. The 20 is still below the 50. Though the 20 and the 50 seem to be slightly closer than what we were seeing on XLY or K, but this is still not the positive movement that we wanted to see. Now, it looks like XLB was revisiting that gap up that we had a few days back. And so really what we need to see in the coming days is if materials will kind of move back into that positive push. But it does look like overall, we are still seeing generally higher highs, though right now we have seen lower lows. So we're still kind of in a neutral area with XLB and XLU. which is utilities. Now we are seeing a much stronger positive movement there, and we do have a positive stacking, and utilities is an extremely risk off area, which a value area, which as well doesn't give you that aggressive growth, or returns, but it's an area that's solid and continues, not year on year, but year over year, we see a positive move in utilities, just not at that aggressive rate that we would with an XLK or an XLY, though now those are obviously turning bearish on us. So then the last one that's really important for us to look at would be healthcare, XLV. And this is also an area where we would see a lot of innovation, a lot of research and development into like the biotech and the biotech areas. And so what we're really seeing here is that inflation is hitting those areas the hardest, where there's a lot of need for research and development, where when it is easier to borrow money and interest rates are lower, that it's easier for those growth and aggressively innovative companies to see expansion. And healthcare is now also suffering from the higher rates and inflationary market that we're facing. So this is just a really great practice that when there have been really strong movements in the market and you're trying to determine, are we kind of heading back to that, like the bullish trend, or are we continuing to face more flat to bearish markets? Right now, we're getting a lot of neutral signals across the different sectors. And of course, we are seeing some negative divergences or negative stacking on those EMAs. So it's definitely something to be aware of. Make sure if the beta weighting of your account is bullish, especially in that kind of growth area, tech, financials, consumer discretionary, that you really are starting to hedge your portfolio, whether that's, selling some covered calls or selling different kinds of credit spreads around your positions, just to help ease the blow as these stocks are trying to find their bottom before they make the next move up. So I hope that was helpful for you guys. And I think that this is an important conversation. Next, we're going to be talking a bit about, again, revisiting the conversation on the VIX 3-month over 1 month, and looking at the put call ratio in the composite and specifically in the equities market to see if we're getting any positive signals there that might give us a bit of confidence that we're moving back towards the uptrend. But the sectors are certainly not giving us those, really like positive energy about moving back into the uptrend that we had been seeing substantially in 2020 and most of 2021. So have fun trading, guys, but really also be cautious about these different just the neutral movement that we may be seeing, or even choppy action that can cause you to feel stressed out if you are in a lot of long call positions or long options that are underperforming. If you had been expecting a lot of bullish momentum during this earnings season or into the earnings season, which we just haven't had as we normally have in the last 5, even 6, 7 quarters, where we've seen a lot of bullish movement into those earning reports. So bye for now, friends.